I think then we're going to go ahead and get started. So just on the agenda today, what we're going to go over. So we're really going to look at that action plan and what are the things that you should be considering in the planning stage of implementation. Then when you actually get into, okay, what are the steps or action plans I need to do now that I'm getting ready and I want to, have that implemented. So some considerations, steps that you can actually take. We will go through a few more key examples of the accounting for the lease standard from the lessee's perspective in operating leases. So in our first webinar, we went over a very basic, simple one. Today, we're going to be building upon the complexities. It's going to be a little bit more complex, and we're going to get through a little bit more complex examples. And then finally, we'll be going over, what you should be doing to ensure that that schedule of leases that you have now produced is maintained. And now I'm going to turn it over to Dave, who's going to walk us through the next few slides.
Thank you, Kristi. As Kristi mentioned, the first part of this section here is going to be for planning for the new lease standard. We're trying to put forth an action plan to help you build a plan going forward on what you need to do to find the leases, list them out, and make a schedule. So moving forward, our first step in the process is to determine who's in charge. You're going to need to appoint a project manager or a point person. If you work for a big organization, maybe you'll need to build a team to implement this. But our big hint for today is if you're attending this call, if you're on today's session, that person might be you, whether you're at a client or whether you have clients for which you're going to help implement this standard. So our next step in the process is identifying the leases. And again, our overall goal here, you need to determine the full lease population and then accumulate the lease information, find the supporting documents that you need in order to help build a list with all the applicable terms. So common leases and the things that immediately come to mind that are applicable to several organizations would be, first of all, your facilities, offices, warehouses, buildings. You'd also want to consider vehicles, whether it's company cars or delivery trucks. Office equipment, copiers, computers, postage meters, for example. Also consider your warehouse equipment, forklifts, computer software, servers, all of those types of items. Those would be the standard items in the first area where you would really want to start. But then moving beyond that, you should dig a little deeper and talk to the individuals within your organization. So the first step we would suggest is to engage the stakeholders and talk to those who sign the contracts, talk whoever that may be. If it's the president, the executives in the C-suite, maybe your organization is large enough and you have a separate purchasing department. Speak to whoever signs the actual contracts. Then walk around your office spaces and your facilities. Look around the office for physical assets that may be leased. And then finally, review the books. Check the expense accounts in your general ledger, as well as the footnote disclosure in your financial statements to see what's included in what you're disclosing. And don't stop just at the rent expense or lease expense accounts. Dig a little deeper. Consider your postage expense accounts where you might have a postage meter. Your office expense accounts may have a copier. Vehicle expense may have your car payments grouped in with your gasoline and your maintenance charges for the vehicle. So remember to talk to individuals, walk around, and then dig into some of your expense accounts on the books as well. Now, as a refresher, as you're looking for leases and identifying them, we covered this in the first session, but it makes sense to, again, address it here. Ask yourself, is there a lease and is there an identifiable asset? So in order for there to be a lease, there would have to be a right to control as well as an identifiable asset. And the right to control would require that you, as the lessee, receive all economic benefits from use of that asset. And you also have the ability to direct the usage of the asset accordingly. And one thing to consider, which is a little bit of a hot topic going forward, is that you should consider embedded leases. Those are components of contracts that entail use of an asset where the user has control over that asset. So as an example, right now, in terms of those hot topics, consider your contracts for data center services or cloud storage. So if customer data is stored on a dedicated piece of equipment and the customer is able to direct the use of that equipment, then the customer has control. So even though you might have only signed a contract for storage services, it may be the case that there's an embedded lease based on that criteria. And the second piece, again, is to ask whether there's an identifiable asset. An identifiable asset is defined as being both a physically distinct asset and the supplier does not have substantive rights of substitution. So continuing our example for cloud storage or data center services, and that data is stored on a server, if the lessor can reconfigure or replace the server on their own without conferring with you as the customer, then that would not indicate that there was an identifiable asset because they're able to reconfigure or replace on their own, as opposed to you as the customer directing the usage of that asset. Additionally, another refresher from our first course, as you're accumulating information for the list, certain arrangements are outside of the scope of the lease standard. So specifically excluded by the accounting pronouncement are construction progress, intangible asset leases, biological assets, service concession arrangements, and leverage leases. So now that you've done the work to go in and find all of these leases and you've accumulated the details, you would want to create a list in Excel, or there are other software solutions available, and accumulate the lease details. Again, Excel can accumulate these lease details, but it's only as good as the information that you find and enter into it. So you do need to work on that previous step in order to identify all the leases that are out there and all the leases you may have. So what are the details that you need to document in Excel? Because we're going to use this spreadsheet then to do the calculation in part 2, which Kristi is going to cover. So what are the details that you need to list? Over on the right side of the slide here, you see the key components. The first item would be the commencement date. And the commencement date is defined as the date on which you take use of the asset, even if you are not making payments yet. That's the period that the right of use asset that we're going to calculate will be, in which it will be recognized. For the next item, you will want to document the lease term in terms of years and months. Now, the lease term might be modified by the next item on the list, your options to renew. And the inclusion of the options to renew are based on who has the right to exercise. If the lessor has the right to exercise that option to renew, you would include that in the lease term. If you as the lessee had the right to exercise the lease term, it's based on probability and whether it's more probable than not that you will then exercise that right and continue forward. You'll also want to document the interest rate of the lease if stated in the lease. If it's not clearly stated, Kristi will give some guidance on what interest rate to use if not separately stated in the agreement. Next, you would include your payment amount, whether fixed, variable, or etc. And we're going to talk about more details related to the payment amount on the next slide. You'd also include any prepayments or down payments that you made on the lease. You'd also include any lease incentives. And again, we're going to cover lease incentives with a few more details and examples on the next page. You'd include initial direct costs incurred in exercising that lease. And again, we'll have a little bit more guidance and further discussion on initial direct costs coming up. And you would also include the lease and non-lease components. In session 1, we recommended that if your lease includes both lease and non-lease components, and an example of a very common non-lease component would be your common area maintenance charges, your CAM charges. And we suggested that you would accumulate all of those costs together and include all of them as a practical expedient. That'll make the accounting a little bit easier for you. Now, as you make this list, you can elect to retain traditional off-balance sheet treatment for short-term leases of 12 months or less. However, our suggestion is that you would keep them on the list as you're building your list and accumulating data. Some of those short-term leases may have options to renew that would then extend the lease term beyond 12 months. So rather than just simply excluding them automatically, it's probably best to include them on the list for further consideration going forward. And again, as you're building this list, consider some of your reporting requirements. You may have several different entities, subsidiaries, cost centers, and divisions or units with leases. And so you'd want to make sure that each entity's balance sheet is properly stated. So consider those reporting requirements. Additionally, it's one of the common arrangements that we see among our clients would be intercompany leases, with one company holding a building and leasing it to the operating company with related party arrangements. And again, you'd want to ensure that both companies are properly including their information so that you'd be able to eliminate the appropriate balances and consolidation. And of course, one other consideration to mention going forward, as with all FASB standards, everything is always subject to materiality. So if something is clearly immaterial, you can retain traditional off-balance sheet financing. But again, you just may want to consider what your materiality levels are in consideration of what your auditors might consider what those materiality levels are. So again, as promised, there's some further details on lease payments here to include in the calculation for the right of use asset. The first item that you would you'd include fixed payments. So that's what we see in most leases. There'd be a standard fixed payment. Obviously, you'd include that. You would also include if there was a variable payment that is based on an index. And by that we mean a payment that increases annually based on a prime or LIBOR or other index rate. You would subtract lease incentives. An example of a lease incentive then would be a cash payment from a lessor at the date of execution. If a landlord had a facility that they really wanted to rent out and had been empty for a while, maybe they made a cash payment to you on the date of the lease to incentivize you to move in and to help defray some of your moving costs to move into that facility. So any cash payments or incentives that the lessor was paid to you to enter into that lease would then also be subtracted from your lease payments. You would also include the exercise price of lessee options to purchase an asset if it's reasonably certain that you're going to exercise that purchase option. Also include any amounts that are probable of being owed by the lessee under residual value guarantees. So as an example, if you're leasing heavy equipment for a big construction project and you're planning to put a lot of wear and tear on that equipment, there might be a residual value guarantee included in that lease. And in that case, you'd want to include any payments that you think are probable to return that equipment back at the value that was promised. And you would also include non-cash payments relating to the use of the asset during the lease term at fair value. An example of this would be a barter transaction. So if an advertising agency leased a company car and they wanted to reduce the payment, maybe they promised the auto dealership to provide a certain amount of advertising services every month. And so the value of the non-cash services would then be included at fair value. Now, certain items that you would not include in your lease payments would be a variable lease payment based on something other than an index. So rather than an index rate, if there was an additional cost for usage fees on a copier or a postage meter, you would not include that portion of the payment. You also would not include a guarantee by the lessee of the lessor's debt. Certain leases may have a clause that contain a guarantee to cover the mortgage, and you would not include any such guarantees. Also, you would not include amounts allocated to non-lease components. Again, we just discussed and said our suggestion is that you would include non-lease components such as common area maintenance as a practical expedient to make it easier on yourself. However, if you do decide to segregate the non-lease components, then obviously you would not include them in the lease payment amount. We also mentioned that we were going to provide a little additional guidance on initial direct costs. So the overall theme here is that initial direct costs are incremental costs of a lease that would not have been incurred if the lease had not been obtained or executed. So you would include commissions to agents or payments made to existing tenants to incentivize them to terminate their lease, because those payments would be incurred only if the lease is executed. However, you would exclude legal fees and costs of negotiating leases and other costs that were leading up to the point at which the lease would be executed. Also, there's a specific exclusion for sales taxes. And so in general, the new guidance under FASB topic A42 allows for fewer lease origination costs than would have otherwise been capitalized under previous guidance. And at this point in time, we'll take a brief break here to mention our first keyword. Our first keyword is sunshine, because everyone says during busy season, I'm such a ray of sunshine from February through April every year. So our first keyword is sunshine. So moving on then, beyond our initial direct costs, now that you've built the schedule, you've accumulated the data, you have the key information in there, we need to start to organize the schedule. Our first point that we would mention is that you can group together leases that have similar terms and similar interest rates. Back to our construction equipment example, if you have a major construction project ongoing and you lease a dump truck, a backhoe, and cranes all at the same time, you don't have to account for all of those leases separately. Chances are you've leased them from the same company, they have similar interest rates. You can include all of those leases together if there are similar terms and similar interest rates. Next, you would categorize your leases by finance or operating. Finance leases are the new term for what we used to call capital leases, and the criteria on the right side of the page is essentially consistent or identical with what capital lease is required, which is that the present value of the lease is equal to more than 90% of the fair market value of the asset. The lease term is greater than 75% of the asset life. An option to purchase is less than fair market value, or ownership transfers at the end of the lease. If any of the four criteria are met, it would be categorized as a finance lease. And a point to mention here also is that you do not need to reassess your classifications due to implementation of the standard. So if you have capital leases on your books, they're going to be called finance leases going forward, and your operating leases are will be continually reported as operating leases. However, the accounting for operating leases now changes going forward. And again, just to reiterate the point, if you find that you have a number of leases and the number is kind of out of control and it's not efficient for you to perform your calculations within Excel, there are software vendors out there to streamline your lease accounting and management if you choose. So as we wrap up this section of the presentation for today, we'll finish again with a refresher from the first course on the new lease standard, which the overall point is that all leases are going to be included on the balance sheet. Your finance leases already were, but your operating leases will now also be included on the balance sheet. So your capital leases, which are now called finance, there was really no significant changes to the accounting treatment. On the operating side, however, you're going to calculate a right of use asset as well as an operating lease liability. And with that, I'll turn it over to Kristi, who will walk you through the calculations.
Thanks, Dave. So now that we've gone through a little bit more details on the action plan and the terms, one of the things that I wanted to share with you in this lease webinar is a few more examples that add a little bit more of the complexity into it. So looking at this slide, again, it's a refresher from the lease webinar 1 to go over for operating leases, how do we calculate that operating lease liability? It's really that present value of the future minimum lease payments. Using a discount rate, as Dave had mentioned, if it's known in the lease, you would use that rate that is offered in the lease. If there is no rate in the lease, then you can either use the lessee's incremental borrowing rate or the risk-free rate, which is typically the 3-month treasury bill rate. And you can use that rate as of implementation date. You don't need to go back in time of when that lease originally started. Now to go to the left-hand side, that right of use asset, that is really calculated using now that lease liability that you've calculated, adding any initial direct costs, adding any prepaid lease payments, and reducing it by any lease incentives incurred. Again, just a refresher from what we went over in Lease Webinar 1. Now I'm going to provide 3 different examples to walk through. So starting all the way to the left, this first example is the simple example that we presented in Lease Webinar 1. So just to go over that simple example, all of my leases are a 10-year annuity with a borrowing rate of 10%. In my first example to the left, I have payments of $162,745 each year. And the present value of those payments is $1 million. So in my simple example, I am recording a lease liability of $1 million and my right of use asset as $1 million as well. Moving into the middle example, now it's getting a little bit more complex. This example defines what happens when I have variable lease payments. So similar instances to the first example, except now my payments are $150,000 for the first 5 years of the lease, and then they change to $175,490 for the second 5 years of the lease, which will change my present value. So now my present value is the $981,683. And again, because there's no other complexities in there, my right of use asset is $981,683 and my lease liability is $981,683. Moving over all the way to the right, in my third example, I'm going back and using that simple example again, but now I'm adding the initial direct cost. So in this particular example, I incurred $20,000 of initial direct costs to obtain this lease. So in this case, my lease liability is still my present value, $1 million. Again, it's the same factors in the first one. However, my right of use asset, if you remember from the previous webinar, is $1 million plus my $20,000 initial direct costs. So in this case, my right of use asset is $1,020,000. And I'm reducing my expense, so taking those initial direct costs out of my expense to put them into my right of use asset. Going on to the next page, I'm going to walk you through what that first year of accounting looks like. So again, starting at the very simple, all the way over to the left, that very simple example, my lease expense, which is always straight line, in this case where my payments are the same each year, my lease expense matches my payment, which is $162,745. My lease liability credit is essentially my $1 million lease liability times the 10% interest, so $100,000, and my right of use asset is the offset of the two. Right underneath that, you will see I made a payment at the end of the year, so I'm debiting my lease liability by $162,745 and crediting cash. Again, that's a simple example that we walked through in the first webinar. In the middle example, now looking at my variable payment example, same terms as we just showed, my lease expense, even though my payments are variable, so the first 5 years of $150,000 and the second 5 years of $175,490, my lease expense has to be amortized on a straight line basis. So my lease expense is $162,745. My lease liability, remember the calculation is my lease liability times my interest rate. So remember we recorded a lease liability of $981,683 and I'm multiplying that by the 10%. So I get a credit to my lease liability of $98,168 in this example, with my right of use asset as the offset. At the end of the year, I'm going to make that first payment of $150,000. So I'm going to debit my lease liability for $150,000 and credit my cash. So you'll see in this example, my income statement and my cash flows might look a little bit different. Moving over to the right in my simple example again, and my lights have gone out again. And I can't get them to go back on. There we go. Moving all the way over to the right in my simple example with my initial direct costs, that again, in that first year, so my lease expense very much the same with the 162,745, but my initial direct costs also have to be amortized on a straight line basis. So if it's a 10-year annuity, my initial direct cost, 20,000 divided by 10, is going to add $2,000 to my lease expense each year. So if you look all the way to the left, you see my lease expense was 162,745. I'm going to add $2,000 because I also now need to amortize my initial direct costs. And I have a lease expense of 164,745. My lease liability, again, was $1 million. The million times 10% would give me the $100,000 credit to my lease liability. And my right of use asset would be the difference between the two. At the end of the year, I make the payment and I have a debit to my lease liability of 162,745 and a credit to cash. Now, to kind of help guide you, I have shown what the amortization schedule for the full 10 years are. I'm actually going to walk you through what it looks like in each example, and you can kind of see that at the end of the period, I've fully amortized my right of use asset. So in this first one that we have kind of centered a little bit on the screen, you can see in my very simple example, we have, the lease expense at 162,745, which mirrors my payments because they're straight payments. My interest calculated, again, is that lease liability times my 10%. So it reduces each year. And my right of use asset is the difference between the two. So by the end of year 10, I have fully amortized that right of use asset. Now I'm looking at that middle example with my variable lease payments. Again, remember, because my lease expense must be amortized straight line, even though my payments vary from the first 5 years to the last 5 years, my lease expense needs to be amortized straight line at 162,745. My interest is that lease liability times the 10%. So in that first year, it's the 98,168. And my right of use asset amortization is the difference. And you can see at the end of 10 years, I have fully amortized that right of use asset we initially recorded of 981,683. Looking at that last example, again, with that lease expense needing to be straight line and include my initial direct cost amortization, I now have lease expense each year of 164,745. My interest is that lease liability times the 10%, with my right of use asset amortization being the difference. And you can see as at the end of the 10 years, in this case, because we had that $1 million plus the 20,000 initial direct cost, at the end of 10 years, I have fully amortized that $1,020,000. And again, just a reminder, if you're trying to write all this down, there's a lot there. If you fill out the survey at the end, you will get a copy of these slides. And again, we revisited this in the first lease webinar of, what are the required disclosures? So, just to repeat, some of the qualitative and quantitative disclosures are listed here. I'm not going to go through them in details, but the nature of the leases, the short-term lease accounting policy election. So if you're not putting any lease under 12 months, if you're not including those in your leased assets, then you would put a disclosure that you're doing that. Whether you're separating lease and non-lease components. So again, we suggest that you do not separate those just for ease of being able to put together your lease calculations. If you're going to restate comparative periods upon adoption, so are you going to go back to last year and try to, when you show comparative periods, adopt it for that period, or is it you're just adopting it for the current year and the prior period is unchanged? On the quantitative side, Again, I want to call out specifically finance and operating leases need to be called out separately, whether you're calling out the balance sheet, assets, the income statement expense, or the cash flow. You do need to identify operating leases separately from finance leases. And at this point, before moving on, I'm going to provide you the second keyword of the presentation, and that is going to be cupcake. So for those of you that don't know, today is National Vanilla Cupcake Day. So hopefully everybody can go home. You had your sandwich last time. This time you can have your cupcake for dessert. Make sure it's a vanilla one, and you will meet the needs of the National Vanilla Cupcake Day. So the key word is cupcake. And that sounds really good right about now. And then I'm going to turn it over to Dave to continue to walk you through, from a maintenance perspective, what are some of the key things that you can do to ensure that now that you've generated your lease schedule, you've got an idea what the accounting is, what further steps should you take?
Thank you, Kristi. So as Kristi mentioned, again, you've built the schedule, you've used it to perform your calculations. It's your job to keep maintaining it going forward and not let it fall by the wayside. So our suggestion would be that you update the lease schedule on a monthly or quarterly basis. Don't wait a full year to update it. Don't let it get out of control. As you move forward in this process, again, you would want to consider any new leases, modifications, terminations, extensions, or any changes that you may have to that schedule. And again, to reiterate Kristi's point from early on, in the third webinar that we're going to hold next week, we're going to be talking a little bit more detail about lease modifications and some other types of changes. Also consider your leased assets for any impairments or abandonments that may have changed the process. Once you've updated that schedule accordingly, then you can generate your journal entries and update your books for the proper accounting as generated by the schedule. And also consider some of your annual reports, whether they're needed for audits, reviews, and other purposes. Provide your auditors with a roll forward and be able to track the changes from last year to this year, and consider what other disclosures and other changes you might need to track. So as you update that process on a monthly or quarterly basis, remember to continue to engage the stakeholders and talk to those who sign the contracts, and build a process for updates with them. Tell them that you're going to update monthly or quarterly and check in with them, put it on their calendar, keep those meetings ongoing. Share your list of leases periodically with the departments that may sign the leases, the executives, the purchasing department, and then also, again, talk to the accounts payable people to help identify any new leases, recurring amounts, any changes, as they're the people who are probably paying the bills for those leases. So maintaining the schedule routinely on an ongoing basis is going to save a lot of time during your year-end close process.
And that is the presentation materials that we have for today. While I give you the opportunity to enter any questions you have in the Q&A button, I am going to mention again that this is the second webinar in a 3-part series. The last one, which we'll hold next Wednesday from 1 to 2, we'll really revisit, as mentioned, lease modifications. So if you modify a lease before the lease term is fully complete, how do you adjust that right of use asset and the lease liability? What does that look like? What happens if I go from a finance lease to an operating lease now that that lease has been modified? So we'll go a little bit through some examples, some of the accounting of that. We will also look at lessor accounting. Although lessor accounting hasn't changed a whole lot, there are some things that have changed, and we will walk you through that. We will look again at some embedded leases and related party leases and just give you some more information on those, as well as walk through a sales leaseback transaction. So building upon the complexity, that last one will be more of the special considerations, a little bit more complex into the accounting, which is why we'll provide you some examples. So that would be next Wednesday from 1 to 2, if you'd like to join us with that. And then we will open it up to questions. If anybody has any questions, Caitlin, who's our great moderator today, will be happy to share those back with us. And we'll try to answer any we can today. If we can't answer it, we will certainly follow up with you accordingly. Caitlin, did we have any questions coming in?
Awesome. Thanks, Kristi. We do have a few, but I do want to encourage people just to continue asking in the Q&A chat box as we work through the first few. There should also be an anonymous option as well. So if you're shy, you can just check ask anonymously and we won't even know whose name is behind it. So feel free to just keep setting those in as we go through these first few. Kristi, this one is for you, actually. It says, how are contingent lease incentives treated in determining the right of use asset?
So contingent lease incentives. So we had talked about how lease incentives should be included in that right of use asset. But when there's a contingency, it's really a policy election, believe it or not. You can choose if the contingency is based on the lessee's control and it's probable, then you can choose to estimate that lease incentive and include it in your right of use asset. However, if you decide you don't want to do that, you also have the opportunity to remeasure that right of use asset when that contingency is completed or fulfilled. So it's really a policy election, whether you want to include it up front or you want to remeasure that right of use asset when that contingency is complete. Good question.
Awesome. We have another one that just came in. Just grab that. Okay. How do I know if I have an embedded lease?
I'll take that once. We talked a little bit about, I talked a little bit about embedded leases earlier. And again, one of the big changes under this new topic is that certain contracts of the old standard that were never considered leases now qualify as leases under the new guidance based on embedded leases. And the idea behind that, once again, is that a contract is a lease or contains a lease if it conveys the right to control the use of property, plant, or equipment explicitly or implicitly for a period of time in exchange for consideration. And the lessee has the right to control the use of that asset throughout the use period and also has the right to obtain substantially all of the economic benefits. So if you have a contract and that contract indicates that the lessee has the right to control the asset and obtain substantially all the economic benefits during the period, that would qualify as an embedded lease.
Awesome. Thank you. We do have another one. How are leases treated that are acquired in a business combination?
I'll take this one. So if you're acquiring a new business and they have leases, typically you don't have to reclassify whether the lease is finance or operating. You can use that classification based on what the original business had classified it as. However, in general, you do have to remeasure the right of use asset and the lease liability as of the acquisition date. So I say in general, because there's always, exclusions to that. And I won't go through and kind of list them all now, because I'm sure I don't have all of them known off the top of my head. But in general, you typically have to remeasure the lease liability and the right of use asset as of the acquisition date.
Okay. And it looks like we have one more, but we do have some time left on the clock. So anyone who's still logged on, of course, feel free to keep submitting those questions. We do have one more. What is the difference between lease and non-lease components? How are they handled?
Yeah, so we talked about that a little bit earlier, but to break it down again, the lease component of the contract that conveys the right to use the underlying asset, for example, the rent paid for an office building, that is considered the lease component. Now, your non-lease component would be a portion of a contract that are goods or services that are not required for the use of the underlying asset. And the example there was common area maintenance charges. They're included in the contract, but they're considered non-lease components since they don't convey the right to use. However, as in terms of handling them, we did mention before, our suggestion is that you would group them all together as a practical expedient to make it easier for you in terms of tracking the accounting. However, if it's clear enough to break them out and you choose then to segregate them accordingly, then in that case, you would not include the common area maintenance charges, the non-lease components within your lease payments. But again, we suggest to make it easy on yourself and include all of it within your lease payment amount.